What's up you guys, I'm Dan, this is Frugal Not Cheap, and today we'll look into whether or not there's an index fund bubble brewing. Hey guys, so today's video is inspired by a question that I got. A commenter named Rex Mundi asks, what's your opinion about the comparison between index funds and subprime CDOs? When I first saw this question, I had a hard time seeing how the two were related, but then I remembered that a couple of years back, this was I think around September of 2019, that there was an article that came out where Michael Burry, who is one of the famed investors that profited off the great financial crisis, the crash and meltdown of the mortgage market at the time, specifically through credit default swaps, that he had come out with some statements indicating that there were some problems with index funds. So, considering that I personally am a passive index fund investor, most of my portfolio is composed of Vanguard index funds, both the total US stock market and the total international stock market. I basically don't own any individual securities. The only two that I hold is one share of Berkshire Hathaway to get a Geico discount, and also a little bit of Tesla that I bought a few years ago. I've been meaning to do a video specifically about the index fund philosophy and why I favor them, but there's something I talk about in most of my investing related videos, so you can check that out. Actually, I put quite a bit of effort in a lot of those videos, and the channel was younger than now, so viewership was lower, but I think there's some really good stuff that's in there. One of the ones where I talk about sort of my investment philosophy is the one where I talked about how my Tesla shares had grown by 1,000%. That was the return at the time. And there I talk about how I think about individual stocks and what their place is in a portfolio. Anyway, so Dr. Michael Burry was interviewed back in 2019. And I will say that, he's a very smart guy, and what I know about him only comes from reading the book, The Big Short, which is a fantastic read, by the way, and then also watching the movie, The Big Short, as well, which is also very, very entertaining, highly recommended. Anyway, what he had to say about index funds is the following. Passive investing has removed price discovery from the equity markets. The simple theses and the models that get people into sectors, factors, indexes, or ETFs and mutual funds mimicking those strategies. These do not require the security level analysis that is required for true price discovery. Then he goes on to say, this is the more sort of ominous part, this is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in that price setting in that market was not done by fundamental security level analysis, but by massive capital flows based on nobly approved models of risk that proved to be untrue. So pretty honest. And then he goes on to say the dirty secret of passive index funds, whether open-end, closed-end, or ETF, is the distribution of daily dollar value traded among the securities within the indexes they mimic. In the Russell 2000, for instance, the vast majority of stocks are lower volume, lower value traded stocks. Yet, through indexation and passive investing, hundreds of billions are linked to stocks like this. The theater keeps getting more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally. When the flows reverse, he suggested, it will be ugly, and that, like most bubbles, the longer it goes on, the worse the crash will be. So that sounds pretty alarming at first glance. We're drawing a parallel or an analogy between index funds, which is an increasingly popular investment strategy that relies on the fact that it's very, very hard to beat the market, so that instead we could just own the market. I was drawing a parallel between owning that, a basket of stocks, with the subprime collateralized debt obligations, and specifically synthetic subprime CDOs, from the great financial crisis. So there's a little bit of jargon, and there's a whole lot of complexity to Dr. Burry's statements here. So let's kind of break down what he's saying. And I think that he's pointing out two main problems. First, he says that there's a problem with price discovery. The notion that normally the buying and selling of a security or whatever the financial instrument is is done in order to discover what the true price is, right? Buyers are willing to pay what they think it's worth. Sellers are going to sell it for what they think it's worth, and eventually, through the market operation, they arrive at the true price, or at least the true price for that moment, given the information that's known at that time, right? And he's famous for seeing that the price discovery process was broken when we look at synthetic CDOs. So what are these things? And by the way, do again recommend reading Michael Lewis's book, The Big Short, or watching the movie The Big Short, because they do explain that. In the movie, they do these funny little cameos with, Margot Robbie or Anthony Bourdain or something like that, teaching you some of the financial jargon. But in any case, basically, the CDOs were packages of tranches of mortgages, where each tranche or kind of lot of mortgages had a different assigned risk rating. But when you combine them all, in theory, this kind of gave you a diversified portfolio of mortgages in this CDO, and so the whole thing was relatively safe. And then the ratings agencies would give that CDO a certain rating on how safe it is, right? It might be AA or double B or AAA or whatever. Then a synthetic CDO is a derivative of that. So it's an instrument that is linked to that. It's sort of like a side bet, is the way they describe it in The Big Short. In my personal business, I trade futures, but I also trade synthetic futures. So it is something that mimics or works like a futures, specifically done through derivatives. We do it through a combination of a call and a put at the same strike price, and this gives you the same type of behavior as a futures contract. So this is an instrument that gives you the same type of behavior as the underlying sort of the linked asset, collateral as debt obligation. And then again, because all of the ratings were bogus, because all of the analysis was not done on all these mortgages, right? The fundamental assumption that the mortgages would not default, or would only default in an uncorrelated way, proved to be completely false, right? I mean, so we found out that mortgages were being written without, income or income verification or employment verification, and just there was fraudulence up and down the board because of a lot of, quite a lot of reasons, probably too much to get into in this video. But the point is that we had a problem of price discovery. This was not working. There were ratings that were completely wrong that were also helping towards that issue. And then on top of that, these CDOs were fairly opaque, right? Until Michael Burry took the time and trouble to look at the individual mortgages that were inside of these CDOs. No one had really questioned to see what's going on. Are these guys defaulting? What's happening with the rates? What's going on? So that's, at least from what I remember the book and the movie, one of the novel things that he did that very few did. So that part all makes sense. But the problem is, does this make sense when we look at index funds? And I'm not so sure. We'll talk about that more. So that's the first problem, though, is price discovery that he points out. The second issue that Dr. Burry points out is essentially a liquidity problem. He says the theater is getting more crowded. In other words, there have been huge fund flows into index funds, right? So there are trillions of dollars now in these indexes. And he's saying that the exit doors, however, are still the same size. So we have a ton of people in a theater with the same size exit doors, meaning there's going to be, if there's a rout, if there's a panic, only limited space to exit. And there could be a long squeeze. There could be some real problems in the market if there were to be some kind of a crash. So obviously this is something that did happen during the financial crisis, where these assets that were assumed to be worth quite a bit one moment, then all of a sudden were worth very, very little. And there's a huge problem of leverage as well in the system, so that you had in some cases just this one tranche of mortgages might then be linked to a really gigantic position. And so things were really out of proportion. And so that was another reason for the giant mess. So now the question is, are these parallels, do they make sense when we look at index funds? And so again, I'll say, look, Dr. Burry is very smart. And he also had the fortitude to carry this bet through, even while he was being margin called for a long period of time, because it took quite a while before the bet eventually paid off. It's hard to be right, and it's also very, very hard to be right at the right time. And it's hard to hold on to your position, to be liquid until that bet might eventually pay off. So this is just my take. I'm not all that deep into the equity markets. My business is again on the commodity side in oil, but we can still apply some logic just from the basic understanding of how these markets work. So let's look at the problem of price discovery. And here I think that while the analogy that he makes is an ominous one, that doesn't mean that it's necessarily appropriate. So I would say that the price discovery problem that he's highlighting is a bit overblown. So let me explain why. So to step back just a moment though, the price discovery system, again, as we talked about, works well when you have buyers and sellers that are well informed and that are engaged in trading in the market to try to get this, that have the effect of getting whatever the asset is priced appropriately given all known information at that time. So that's active trading, whereas passive investment is really just a buy and hold strategy. And these indexes are these kind of passive strategies where they just mimic the market capitalization structure of the market. A lot of them are market cap weighted indexes. Those are the ones that I buy personally, for instance. And so he's right in the fact that when you buy into an index, there's no fund manager that's actively doing any kind of analysis on the quality or the prospects of any of the securities that underlie the index, right? The different companies that make up the index. So for instance, when you buy the S&P 500 index, there's not someone that's actively looking at everything about each of those companies in the S&P 500, although there is a committee that decides on inclusion of a stock into the S&P 500. But again, he's right that we don't have that security level analysis. And so this could have the potential to cloud the price discovery mechanism if it were indeed sort of the bulk of trading activity, right? So if most of what was going on was just this kind of blind buying, then of course it would stand to reason that this could screw things up. But let's look at how big the passive index fund market really is compared to the total market. So here in the US, and these are some figures from not too long ago from Bloomberg, we see that passive index funds or passive investment funds account for over half of the US fund market, right? So 54% of US funds are passive, and the other 46% are actively managed funds. And it could be higher because there could be some actively managed funds that are sort of closet indexers. So they mostly follow the index, but they have a couple tweaks here and there. So it could be higher. But again, this is the slice of the pie of the fund market, not the total US stock market. When we look at that, then we see that actually index funds account for only 15% of the US stock market. Okay, so that's here in the US. Then let's look abroad. Internationally, actually, the share of funds that is passively managed is even lower at 41%, and only $1.67 trillion of capital are passively managed, compared to roughly a $53 trillion non-US global stock market. So then we're looking at just 3% of the non-US stock market cap. So overall, we could be anywhere between, 10 to 15%, say, even looking at closet indexers, though it could be higher than that. But either way, it's nowhere near being the majority of the total market. And so that's one reason to think that maybe this isn't such a big deal for price discovery. But I think maybe even the more important point about why this isn't such a big deal for price discovery is that it's not the size of the investor that matters. It matters who the marginal investor is, the marginal buyer and seller of an asset. Let's think about any individual stock, right? And let's say, for simplicity's sake, that there are 100 shares out there. And there's someone out there who's, say, Vanguard, right? This giant institutional investor, right? And so they buy 90% of the stock and they just hold it, because that's what passive index funds do, is they buy and hold. And of course they will have to adjust as, market cap weights change and all that kind of thing. But essentially, they're going to be buy and hold, right? Simple way to look at it. So they're just going to hold on to these 90 shares. So after that initial buy, which may or may not happen at one moment, they're not doing any buying and selling. So they're not impacting the price at all. Who is impacting the price? Well, there are the people that are trading the remaining 10 shares. So in this case, we have only 10% of the shares actively being bought and sold, but those 10%, that activity is going to determine 100% of the price discovery, because again, the buy and hold part, the passive part, is a static factor. It's not impacting anything on the margin. So things, of course, are not quite that simple. However, there's still a lot of truth to that idea that it's essentially a relatively static factor, and that the marginal buyers and sellers, the active traders, are still able to influence prices quite significantly and affect this price discovery mechanism. And here I'll take a brief detour and say that you need both, or that one can't survive without the other, and that really, just like if you had a rubber band around an anchor point and you pulled it off really far in one direction, then it would tend to want to snap back towards the center, and the same if you went the other way, kind of a mean reversion thing. There's no way you'd ever have a world of 100% passive, and not anymore would you have 100% active investment either. And that's because there are sort of merits to both, right? And so the passive strategy requires active management for this price discovery mechanism. The active trading will exist because there will always be people that believe that they can get an excess return over the passive investment strategy. And at least for short periods of time, that certainly happens, right? It's very hard to do in the long run, but someone might be able to do that for short periods of time if they get lucky, or if they know something. In any case, that's why both will continue to exist. And as things swing a lot towards one or the other, then there's some sort of built-in mechanism for the pendulum to swing back the other way. All right, so I don't think the price discovery thing is all that much of an issue. And another reason for this is one of the big problems, as we talked about with price discovery, was with the CDOs and synthetic CDOs, is that they were very opaque. People didn't have real visibility about what these assets were, right? With index funds, it's very transparent. So you know exactly which companies are in the index, you know what the weights are for all those companies, and then all those companies, to be included in these indexes, are also publishing financial reports, and there's a lot of data that we have on all of them. So they're relatively very, very transparent. So not an issue there. So again, I think Dr. Burry's statement here about the price discovery problems, I'm not saying that there's no merit to them at all, because yes, these funds are sort of buying blindly in a sense, so that can distort things a little bit at the time that those buys and sells happen when they're rebalancing, adjusting. But because they're essentially a static factor, and for all the reasons we've outlined, I think the problem is quite overblown, and that price discovery is still operating quite well. The other issue that he highlighted was this liquidity problem. And here, I think there is also some merit, but not necessarily a huge cause for alarm just yet. What he talks about here is that there are some smaller companies, so companies where there's very little trading activity on those company shares on a daily basis, but there's a huge amount of assets that are connected to that company through the indexes and possibly things mimicking those indexes, so synthetics. And so this is true. And so this could cause a problem, especially when we think about these synthetics. So here we're talking about perhaps leveraged ETFs, right? So there are some that are 2x or 3x leveraged ETFs. And so they would need to use derivatives in order to create this kind of position, I imagine. And so here, then again, you have this problem of proportion or of leverage, where you have a lot of assets that are connected to like a much, much smaller thing. And so if this thing fails, then there's a cascading effect. And again, you can have very much a long squeeze kind of situation happen and things seizing up as we did in the past. But at the same time, when we look at the non-leveraged ETFs, a lot of the times those don't generate trading within the underlying securities. In practice, a lot of the trades are actually done between ETF holders, and there's not much trading of the actual underlying security unless they have to create or destroy new units of the ETF. So again, there is a little bit of merit here too, but I'm not convinced that the situation is anywhere near near as dire as what he's talking about some big bubble that is ready to burst at any time. So that leads to the final question is, will I do anything given Dr. Burry's perspective here? And for now, no. I won't be changing my personal investment strategy at all. It will be something that I will keep an eye on, but we also always have to be skeptical about when people say that things have changed and things are going to be different. Because, well, things are always changing to some degree, but the ownership of slices of companies, it's very, very difficult to imagine a scenario in which owning pieces of companies is no longer going to be a good idea. And that's essentially what you're doing when you buy index funds, especially not the leveraged ones, which really then you're really just gambling. And they're not designed to be held long term anyway. And we do actually, since that time in 2019, have a little bit of data to lend weight to this idea that maybe we don't have to be all that scared about what Dr. Burry is saying. And that's that we had a fairly significant drop in market prices due to the coronavirus. So the US Total Stock Market Index, VTSAX Index Fund, fell from $83.57 as of February the 14th, 2020 to $56.04 by March 20 of 2020. So this was a 32.9% drop in a relatively short period of time. And yet we didn't see a bubble bursting, as one might predict, given what Dr. Burry was saying. So there's definitely something to think about, and I think there's merit to looking more into how much systemic risk there might be, especially from any kinds of leverage in synthetics that are out there. But in terms of your vanilla index funds, I really don't see any cause for concern at the moment. Now, this is very different from saying that the market isn't going to drop anytime soon, right? I'm never going to make predictions about if the market's going to go up or down. That's just not my business. I'm a long-term buy and hold investor. But I'm just saying that I don't see that there's some kind of an issue that's been caused by increased flows into passive index funds. Certainly not the vanilla ones. So I hope that was helpful. I know there's a lot of jargon and a lot to talk about here. And actually, it does give food for thought for some future videos as well. If there's any of these topics that you'd like me to expand upon in the future and I know something about them, then I will. Just leave a comment below and let me know what those topics are that you might be interested in. And again, thanks to Rex Mundi for asking the question that prompted today's video. If you did find it helpful, please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.